I would like to discuss about the premium liability. And here's the content of this topic. First is we're going to discuss the concept of the premium liability, and second part is the application of the accounting. And the third one is the financial statements. On the second part, we have these three scenarios in order to demonstrate the application or the accounting treatment for this premium liability. First, we have the scenario of acquisition of premiums, and second, we have the recognition of premium expense and liability at the time of sale, and the third one is the redemption of premiums by customers. Now, we have here the concept of the premium liability. So it says here that this is an obligation to provide future goods, services, because of the past sales. Now, part of the strategy of the company is part of the marketing strategy is to allow the customers that if they have some items that they are going to show to the company or to return to the company will going to is going to provide something to them in exchange for that. So, what I mean is that there's a consequence for every sales if you are providing a commitment of this to your customers. Now, we have an illustration in order to demonstrate this one. Happy Foods Company sells Yummy O cereal. Accordingly, for every 10 boxes tops of customers since they can redeem a collectible Yummy Bear plush toy. So each Yummy Bear cost Happy Foods Company 2 pesos to acquire. So Happy Foods expects 60% of these box tops to be redeemed. Now I'm going to explain this. So the company is providing this chance or the right to the customers that if they can surrender, if they can show 10 box tops for of Yummy O cereal, the company has to exchange or to provide them the Yummy Bear plush toy. So this will happen again if the customers is bringing or are bringing 10 box tops to the company in order to redeem for that Yummy Bear plush toy. Now, the cost of that Yummy Bear accordingly is 2 pesos to acquire. Okay. Then the last one is the Happy Foods expect 60%. It means to say that if they have that total sales, only 60% of the customer is going to redeem those box tops. Okay. Now, here's the scenario for the acquisition. Now, during the 2025, accordingly, there were 50,000 boxes that were sold by Happy Foods Company, boxes of Yummy O's. Now, at the time before that happening, on June 1, the company, Happy Foods Company, acquired the 5,000 Yummy Bear plush toys. This is as a part of the preparation on the part of the company that before the redemption date, the company has already the enough or sufficient number of Yummy Bear toys according to their estimate. Now, in the time of the acquisition, the accounting for this one is that for this 5,000 Yummy Bear that is cost 2 pesos per each, it will be accounted as premiums inventory at first. So that's why we have a debit of premiums inventory. And the credit is, it depends upon if the company is using cash or using accounts payable. Okay, so that's the initial acquisition, the entry for the initial acquisition. Now, at the time that the sales were already realized, the company has to estimate how much the number of toys that they are going to provide to the customer in case that the customers will going to send in or to surrender box tops to them. Now, of the total 50,000 boxes, the estimated in case that all the 50,000 are redeemed, so since the customer has to show 10 box tops for to redeem one toy, means to say that there are, in order to compute the number of toys that will be redeemed by the customer out of the 50,000, so they can just calculate by dividing 50,000 over the 10. So that would mean that there are toy that will be redeemed by the customers if the 100% 5,000 will be or if the 50,000 top box tops will be sent in to the seller or to the company. However, the company is only estimating that there were only 60% of that of the total 5,000 estimated that will be redeemed, or yeah, that will be given to the customers. In other words, there are only 3,000 that will be redeemed. So, uh, based on this, the company has to recognize premium expense and a consequence as a consequence of the sales. So, since the sales is 50,000, a consequence of that, there is a premium expense of 6,000 and an estimated premium liability of 6,000. Okay? So again, the premium expense is based on whatever sales that they have made during the month. Okay. Now, at the time that of the redemption or on the redemption date, let's say on the month of July, the customers send in backstops only 2,500. The expected is 3,000, right? But the actual that were redeemed is only 2,500 yummy bears. So therefore, for this, in order to at the time of the redemption, that is also the time that the company is paying off the liability. The estimated liability is 6,000, but the liability that is paid up is only 5,000. Okay, and the means in order to pay the liability of the premium is by giving the toys, which was accounted as premiums inventory. So that's why the credit is premium inventory. There's no cash outlay in here because what is distributed to the customers are premiums inventory. Okay, and again, the debit is estimated premium liability. It's not an expense. Okay, it's a premium liability. Why? Because the expense was recognized at the time the sales was made. In here, this is at the redemption event. So at this time, at the time of the redemption, the liability is paid by giving the toys that were accounted as premiums liability. Okay. Now we are now on the last part, which is the financial statement impact. So how would be presented all those that we have accounted so far? So first is for the estimated premium liability, let's say as of June 30, what we are going to present in here is the 6,000. That's the based on the estimated premium liability that the company has estimated, that they owe to the customers. So 6,000. Again, that is to be presented under the current liability section, under the line item estimated premium liability. And under the income statement, there's a premium expense of 6,000 that was on June. Okay. And if we're talking about premium expense for July, in the given, there is no premium expense in July unless there is another sales that were made in July. Okay. Now we forgot to mention here also the what about the premium inventory? How would that be presented? That will be presented under the current asset. Okay, the premiums inventory. Okay, so whatever is the remaining premiums inventory, that would be presented as current assets. So that's all. Thank you for this premium liability.